The price of gold has been soaring. What's pushing it, what will continue to push it, and what's next? The thing is, there's some geopolitical concerns that are going on, but those seem to be waning. We're now in the third year of the war in Ukraine, and that wouldn't necessarily pressure gold prices much higher. We just saw a bunch of tensions happening in the Middle East with Iran and Israel, but that looks like it's going to wane out and turn into not much more than a diplomatic mission to contain things there. So the pressure in gold prices might be inflated based on that. We still have inflation concerns. But then you start to check the 10-year Treasury note. The yield on the 10-year Treasury is pressuring higher and higher, which assets are starting to sell off. Take a look at crypto. Take a look at the stock market. Wouldn't gold necessarily be next? There's something you need to pay attention to, and it's really eye-popping. I kept looking at it and saying, what am I doing wrong here when I kept looking at these prices? And that's the price of options. The market is definitely betting that gold prices continue much higher. And I'm sitting there saying, you know what? The market might have it wrong. They've had it wrong on inflation, and I've been calling interest rates moving higher. This could break the price of gold, and those individuals buying up those options on gold prices are probably going to be selling quickly. And gold itself, the price might come down. Let's jump in, and I want to show you a couple things I'm looking at. Here we're taking a look at the spot gold prices, and as you can see, March, things took off. Encapsulating it a little bit, here's a broader look. We were stuck in a bit of a range all the way from going into 2020 all the way through to 2023. And of course, this year in March, we've seen a huge acceleration. Now, this is Spider Gold Trust versus gold itself. And as you can see, they mostly go hand in hand. But that Gold Trust, GLD, is the stock. It's an ETF on one of the Spider Gold Trusts. This is the one I'm really going to be focusing on. Obviously, they go hand in hand price-wise. Here is a look at the U.S. 10-year Treasury bond. Bond yields have been increasing. We look set like they're probably going to see the 10-year cross back up into 4.75, pushing into 5, maybe beyond. The Federal Reserve is not where they need to be with interest rates. And if they continue to pressure interest rates higher, which I think they've been more than likely will not lower interest rates this year, but instead raise interest rates this year, but not until after the election, which is in November. They may talk things down for quite some time because they don't want to actually make a move which could upset the apple cart with any kind of presidential election. Because of that, they have the election is on Tuesday, November 5th. There's a 2-day meeting, 6th and 7th, and I'm thinking that's when they raise interest rates. Not lower by the end of this year. But we might see some kind of relief from the economy itself. How much further can it expand? Next week, we got some big economic data points. Durable goods on Wednesday, GDP first look Q1 Thursday, and then PCE, personal incomes, personal expenditures, and the PCE price index on Friday. Wednesday, Thursday, Friday, big data points. That could push the 10-year yield much higher, which would shake the price of gold. It could also really rattle stocks and crypto as well. But here's what I wanted to kind of look at. Here's a look at the actual price on the Spider Gold Trust. GLD is the stock. Again, it's an ETF. And as you can see, we're pressuring higher. Now, I looked at 220 earlier in the day, but it's gone up a little bit higher. Let's take a look, and unfortunately, I do need to put on my reading glasses for this. This is 240 calls, 200 puts. Now, we're basically at 220. So the delta on that is about the same, except the market has pushed the delta upward, and that's the bottom left corner of both of these. So up at the top there, you see the gold 240 calls for May 31st. The delta on that is 0.17. If you're at the money on an option, typically it's between, say, 0.45, 0.5, 0.55, somewhere in there. Basically 50-50 shot. Does it go in the money? down below, if you keep looking, the delta on the puts, the $200 puts for the same date, which is about $20 out of the money as well, the delta is trading at 0.04. So the market has bid option prices up significantly, calls over puts. Take a look at the green there. You see $1.50 for the calls, $20 out of the money, about 45 days remaining, versus the puts, 24 cents. That's a huge, what is that, 6-to-1 ratio? 1-to-6 ratio? That's huge. That discrepancy. They're usually, in a normal market environment, they're usually pretty close to each other. Let's take a look one more time at one other thing. This is 222 half versus 220. The actual price, I think, when I took a snapshot of this, and this is the same date, May 31st, was 221.65. So it was a little closer to the calls versus the puts, but not much. But look at the price discrepancy, and these are basically at the money. These are in between the two prices. There's a $1.60 price discrepancy between the two. Taking a look at the delta on there is 0.52 on the calls and 0.41 on the puts. The puts should be roughly closer to 0.5, 0.475. So they're underbid significantly. Now I'm taking a look at these option prices and I'm sitting there saying, you know what, the market probably has it wrong. I've been saying for months now that the market is not right with regard to lowering interest rates. Interest rates are starting to head back upward. I've also said that toward the end of this year, we're probably going to see a bloodbath in stocks. And that's sort of playing out. We might have seen the high in equity prices, asset prices. And if interest rates continue to move higher, that's it. We saw the high in this cycle. And it may be 9-12 months before we see stocks kind of moving back upward again, which means we probably could see a pretty decent sell-off. Given that, I think that the market's got the price of gold wrong. I believe that with higher interest rates, assuming all else equals, that there's no new geopolitical concerns that would pressure people into rushing in buying gold at Costco. Given that, I expect we'll probably see a price closer to 200, if not sub 200 on GLD stock, the gold ETF, versus going higher than 240. What I'm likely to do is sell a call and buy a put on the, here I'll move this backwards, on the 240 versus the 200. If I sold one call and I brought in $1.50, I could buy 6 puts with that. And if the market turns and moves lower, those puts are going to grow real fast. But I'd probably be interested in some kind of protection. But then again, I'm trading a ratio of 1-to-6. And if the price of gold does continue higher, I could easily delta hedge and protect myself. But I don't think we go above 240 on GLD stock. I don't think that the price of gold continues higher. The geopolitical risks are gone already, mostly. We'll see. At the same time, inflation is going to be, interest rates are going to put pressure higher, and inflation will become contained. The Federal Reserve may have to wait, but they're still probably at least going to talk interest rates up before they make a move. And it may be, because there's still 6 months before the election, when the Federal Reserve has that meeting, it could be that they do have to just merely saying things, pushing interest rates up higher, that could be enough to pressure the economy lower, and because of that we get some kind of contraction because of consumption declining. 6 months is a long time. We'll see how that plays out. Regardless, if you have been a long-time follower of mine, I'm getting rid of my website, moving to Substack. It's just so much easier. Link is down below. Make sure to sign up for the free email newsletter where I break down all economic indicators. If you're just finding my channel for the first time, hit that like and follow button. We'll see you in the next video.